Hello and welcome to this week's episode of Nucleus Investment Insights. Today we're going to discuss the brewing energy crisis for the Australian economy. Energy prices have already increased dramatically in Europe and now they're set to skyrocket in Australia, with wholesale energy prices recently spiking and political factors at play also. Australia is one of the largest exporters of natural gas and coal in the world, yet the energy companies are imposing high international prices on the Australian consumer, which has largely been driven by the war in Ukraine and the push to get off Russian energy. On the agenda today, we'll look at the current wholesale and retail prices for natural gas and coal, which are the main inputs for Australian energy prices, making up about 80% of the market. Then we'll have a look at the history of gas markets and how we've come to the predicament we're facing. Next, we'll talk about why Australia is different from other countries that are rich in natural resources and the lack of preservation in these local markets, especially on the East Coast. Then we'll discuss what can be done about it and if the government has the gumption to try curb this war profiteering by energy companies. Then, as always, we'll discuss the investment implications and the impacts for markets at the end. My name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth. Today, as always, I want to welcome the Founder and Chief Investment Officer at Nucleus Wealth, Damien Klassen.
Hey, Sam.
Hey, Damo. And also on the show today, we have our Chief Strategist, Lewellyn Smith, who's written extensively on this subject in recent times across multiple platforms. Dave, thanks for joining us as well.
Pleasure, Sam.
Thanks, gentlemen. This one's a hot topic, so it's going to be an interesting discussion. Just a bit of housekeeping before we get started. If you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, you can follow us on your preferred podcast platform. Our show's available on all the majors. And for those of you listening live, feel free to drop your questions in the YouTube live stream chat, and we'll do our best to answer them during the show. So now we've got that little bit of housekeeping out of the way, we'll get started. So Damien, I'll hand it over to you to lead us away.
Yeah, thanks, Sam. Look, I thought I'd start quickly with just the background of costs and where they come from for retail investors, for retail consumers, and it's largely similar for small businesses and others. So we'll start with the. I've got a chart up basically, of a little bit of premature celebration, I guess, by the ACCC from last year. Just talking about electricity costs being at an 8-year low, and that looks like set to reverse quite quickly. So you sort of see that average cost there of about 27 cents per kilowatt hour for residential users. Most of that cost comes from the network. So sort of 45% of it is your poles and wires and connections and things like that. And then you can sort of see how the actual wholesale cost, so the cost of your energy is actually only about a third of the cost. So so that's the one which we'll jump in a minute, but that's sort of up 6 times its usual level. So you increase that by 6 times, you're probably looking around about doubling your residential electricity prices at the moment. So anyway, that's sort of a quick history, but I'll flip across to Dave, who can talk a little bit more about the history of gas prices in particular, which has been largely setting the marginal rate for electricity, given that as Sam was saying, we're sort of just coming down. Close to 80% of energy in Australia comes from coal or gas, while that is falling, but still a very, very high number. But Dave?
Yes. Okay. So I'll just quickly run through the sort of magnitude of the price changes to give listeners a feel for how extraordinary it is. So the traditional gas price in Australia is averaged around $4 a gigajoule. Up until around, probably 2014 or so, and it is lifted ever since then when we became a very large gas exporter. through the 3 Curtis Island LNG plants in Queensland. And we've had a number of crises ever since. In fact, I would call it a rolling crisis. And right now, 2 days ago, the forecast price for the day reached something like $800 in the gas market. And so the gas regulator, the AEMO, effectively just shut the market. The market has failed and imposed a $40 fixed price on gas, which is 1,000% higher than the traditional Australian gas price. So that then immediately cascades into electricity prices because gas is the marginal supplier. Gas-fired power is the marginal supplier in the national electricity market, which is the market that exists everywhere east of WA. Excuse me. And those prices, the electricity prices, are now, they were roughly around $50 a megawatt hour not very long ago, and now they're at 300. Moreover, there used to be a duck curve in the prices because there's a lot of solar during the day, which meant that prices would crash to near zero, and then you'd have peak in the morning and peak in the evening. But now it's just sitting at $300 megawatt hour all day. Like, the duck curve has basically been erased for the time being. So what we're looking at here is total market failure for Australian gas. Like, there's no other way of putting it. The suppliers of gas are shipping out too much, leaving the local market short. We've had a cold snap to add to those pressures, but that's really just one of those things. It's a structural problem. And as I say, it's been rolling ever since 2014. We've had repeated crises. Every time something goes wrong and there's a need for extra gas or extra power, the price goes through the roof, and everybody pays through the nose. But this time, because prices have gone so high, it's just a clear market failure, requiring dramatic and draconian regulatory intervention for any sane system. Now, the thing is, you've got to ask yourself what's driven these price hikes, such extreme price hikes right now. And it is global prices. And as Damon mentioned, and Sam as well, it's all coming out of the kind of redistribution of energy flows out of Russian sanctions and the Ukraine war. Okay, fine. So that's an external shock. But it is a war, right? It's human suffering. And there is absolutely no reason why the private companies that run gas extraction in Australia, and they lease those commodities, they don't own them, they are leased to them for the privilege of extraction and selling. This is a war windfall that they have, and that in any ethical or kind of sensible economic framework is inappropriate. Pretty simple stuff.
And the UK has put on super profits taxes to
quite right, which should be actually called a war profiteering tax, right? Because there's no reason why private interests should benefit from this human conflict, and there is every reason for you to conclude that Australians in particular, who are so far away from this conflict, have actually given Ukraine a great deal of moral support, and are an immense energy supplier that is supporting Europe. There is no reason why they should suffer for doing so. None.
Well,
other than the power of the producers themselves.
Yeah, and especially not at levels higher than what the Europeans are paying.
Well, exactly right. So this capped gas price is higher than the European gas price by about $5. It's also about $5 to $10 higher than the Australian gas that's being sold into China. So it's just absurd. Like, it makes no sense whatsoever for an energy exporter to have found itself in this position, and it's purely a question of politics, not economics or ethics or market or even markets. This is all about politics. Okay, so that's the background. So to give you a sense of how egregious this is, I wanted to go through a sort of brief history of how the Australian gas market has been distorted and broken over the last decade by this political power play by a small number of gas extraction firms. So as said, we had this terrific gas advantage in Australia, whereas the price was very low. It drove what remained of our manufacturing sector. It gave us an energy price advantage for electricity as well. And the Australian plan for decarbonisation, this is always forgotten as well, intrinsically assumed that we would have gas. Gas was going to be the bridging fuel between coal and the renewable firming powers like batteries, pumped hydro, etc. The stuff that you turn on when the wind isn't blowing or the sun isn't shining. Gas is much lower carbon has much lower carbon emissions than coal. And so gas was assumed to always have been that fuel because we had so much of it. But then what happened over the last decade that I'm about to describe transpired without anybody really blinking, and that plan just went up in smoke. So we had a post-GFC LNG build-out in Queensland. These are the plants that I described earlier. It was an immense investment. It was like $100 billion, something like that. There is no regulatory regime in Australia to approve these projects, to ensure, at least not in Eastern Australia, there is in Western Australia, to assess the projects on their merits. They get environmental approvals, but that's about it. But the cartel and Santos, as a member of that cartel, actually said in the press that there would be sufficient gas to supply the Australian market, despite having the exports. And I'll actually quote to you what the MD David Knox said at the time when he was commissioning the LNG trains. He said, "You've got to be absolutely confident when you sanction trains that you've got the full gas supply to meet your contractual obligations that you've signed out with the buyers. In order to do it, we need to have absolute confidence ourselves that we've got all the molecules in order to fill that second train." Okay, so what did Santos do? It subsequently to these statements, not very long afterwards, suddenly realised that its assumptions for gas production in fracked gas, which this was all about terrestrial gas in Queensland and South Australia and stuff, unconventional gas, not the stuff that comes out from under the sea in WA. It was a new kind of methodology that freed up these reserves. Santos said it had plenty of gas to fill its trains, but within months it was writing down how much it was getting out of its wells. Within a year or two, it was scurrying around the eastern economy, buying all the third-party gas that was available. In other words, it did not have the gas it said it had, and it bought up all the spare gas to shove into its second LNG train. Now, ever since it did that, from 2014 on, when these plants opened, we've had nothing but trouble with Australian energy prices. Now, is that a contractual obligation from Santos or the cartel? Perhaps not. It's certainly part of a social contract, I would argue. It is on the record, it's in the media, and it shows you that the miscalculation for the amount of gas that Australia had was made by the producers themselves.
But and to come back though as well, David, pretty much every other country that has large reserves of gas does some sort of domestic reservation.
Absolutely.
We'll
come back to that when we talk about the solutions. But
yeah,
100%.
I guess so. Your additional part is that effectively what they were promising at the time was, we've got so much gas, you'll never have the problem where we'll be taking all the gas and selling it to overseas, and people in Australia will have to pay too much. So don't worry about domestic gas reservation. We've got so much gas, it's never going to be a problem. And
right.
As you said, pretty much from day one, it was a reasonable problem, and now it's turned into a what's happening now is exactly what they said would never happen.
It is quite right, and there were lots of people at the time saying this will happen. So the bottom line is to give you some notion of how cheap this gas is, because it basically is cheap despite these enormous prices we're paying. I've added a little table here which came from, I think, an assessment by one of the Queensland regulators, and it shows you the extraction costs for APLNG, which is one of the exporters for gas extraction. Now, these are all in costs. So this includes all the infrastructure that they had to build, etc., to extract the gas. So low gas cost is $3.50, and it goes up to about $8 for the high gas cost. That's US dollars, so add sort of 25% or 28% at the moment. But the point is, this includes all of the infrastructure costs for extracting the gas and getting it to the LNG plants. So if you are going to reserve gas, there's absolutely no reason why Australian consumers should pay for that either. And in fact, the cash cost for getting this gas out of the ground is probably $1 or less. Like, it's next to nothing. Moreover, because they overbuilt these LNG plants in 2014, they actually overshipped gas into a glut in Asia, and they created the price, the export price, for years after they opened. And as a result, they had to write down all their capital costs anyway. So they're already gone, or they're like incrementally going. So for them, they're operating nearly off the cash cost now anyway. And so this gas is just super cheap. But, you know, instead of that being filtering through to Australian energy costs, it's all being sent overseas, and we're paying this extraordinary $40 cap price. So that's you know, kind of the fundamentals of it. We'd made a few more errors. The ACCC was appalling on gas for years. It made a terrible blunder when it allowed Shell to buy both one of the Curtis Island operations and then buy the last big reserve of frackable gas on the East Coast in Arrow Energy, which basically consolidated 80% of terrestrial gas reserves on the East Coast within this cartel. So, you know, the ACCC has got a lot to answer for here as well. Then on top of that, we have the legacy of the RSPT, the super profits tax under Kevin Rudd, which allowed, you know, you may all recall it was an attempted super profits tax on iron ore and coal, I think, which resulted in an extraordinary political boil-over in which Kevin Rudd lost power. And when the Treasurer Wayne Swan and the new Prime Minister Julia Gillard renegotiated the RSPT with Rio and I think BHP and possibly Glencore in the cabinet room, the miners basically presented their own version of this tax regime, which was hideously distorted to their own benefit. And, you know, Wayne Swan and Julia Gillard just signed away. So the result of that is that despite this gas cartel shipping all of this stuff offshore, reaping extraordinary super profits and economic rents and war profiteering, they pay no Australian tax.
And I think I've seen, I can't remember the exact
number. Santos pays a little, I think, but basically they pay next to nothing.
Yeah, there's a few incidental they pay, you know, there's a bit of GST they pay every now and again, and, you know, pieces. It's very incidental. But I think as well, they've still got tax losses equivalent to, at one stage, I think it was almost 20% of Australian GDP. Might be down to like maybe 15% or something now. Yeah. But like they've just got these extraordinarily high amounts of losses that they still need to work through before they're ever even going to pay tax.
Yes, that's right. And I think it was Chevron who actually declared in a US market release that it will never pay Australian tax. Okay. Like over the 30-year life of Wheatstone and Gorgon, it is that confident in its capability to manipulate the system that it will never pay tax. That's like been declared to the market. So, I mean, that's obviously West Coast and is a separate question, but, you know, it gives you some idea of how this cartel operates, what its values are, and how much how much it cares about, having any kind of social license to operate in Australia. Okay, so giving you that background, we'll just flip over now. I'll flip back to Damien, and he can run through, given so far the Labor government has committed to doing absolutely nothing to resolve this. And so we're going to have a look now at the global gas markets and see, is there any prospect of them coming off before we can come back to the possibilities of Australian solutions.
Yeah, and so what I wanted to come from is basically this view that, look, Europe is the marginal price setter at the moment because they're trying to so desperately get off Russian energy. They're basically buying up whatever they can and replacing it. So, yeah, replace Russian imports with whatever else they can. And so until you can sort of see some sort of resolution for Europe, it's very difficult to see a resolution for elsewhere. So I just wanted to sort of highlight, this. I've got a map up of Europe and where it gets its energy from. So there's a couple of red lines coming in. So there's four major ones, and that's all the Russian gas. So the Nord Stream, which basically goes through the sea underneath Scandinavia, between Scandinavia and Europe. So that comes in. The Nord Stream comes in there, so effectively doesn't pay anyone for doesn't have to pay countries for sort of transmission fees. And then they built the Nord Stream 2, which was sort of what started to sort of highlight some of these problems last year. The Yamal, which goes in via Poland, basically almost no gas is sort of going through that anymore. That's sort of all tailed off. The Nord Stream's going at full tilt. The Ukraine, that's also going at almost nothing. So I guess with this idea that Russia just doesn't want to pay the additional money to any of these countries it's passing through. And the bottom one, the Turk Stream, which is a relatively recent one built as well. And again, that mostly goes through the ocean. So again, they don't have to pay the fees. And then you've got LNG coming in. There's a bit of gas in the North Sea, but that has been falling for years. So Norway and the UK sort of supply that into the rest of Europe. And then right down the bottom, you can see there's some gas comes in through Algeria and Libya. In terms of gas that's coming back across to Europe from Africa. Then if you look at the amount of gas imports so far in 2022. So I've got these two charts up. The one on the left is showing the total amount of European imports, and the dark red line is the 2022 numbers. So you can see that that's basically running at a pretty decent clip. Like it's basically running at 5-year highs. The dotted lines are the high and the low, and it's pretty close to the 5-year high that is running at. The one on the right shows the amount of Russian gas that makes up that one on the left. And you can see that's running at 5-year lows. So gas into Europe's running at 5-year highs. Russian gas is running at 5-year lows. They've actually done a reasonable job. They're basically running at probably half or less of what the usual level of imports are. So they're sort of already part of the way there. With more sort of coming in, LNG is probably the biggest hope there that they'll get some more from the US and other countries. Then if you look at the storage, which is on the next one, same one. The one on the left is showing the amount of gas that's in storage. They need to build up throughout the year and then into winter and then run it down again. So they're last year was pretty bad in terms of the storage. This year's looking better at the moment. So there is a reasonable amount in storage. But the one on the right then shows that the amount of storage the amount of gas in storage coming from Gazprom, which is the big Russian supplier, is basically none. So, building up gas. So lots of gas coming in, and they're building up reserves. So it is looking sort of manageable at the moment, with not a lot coming from Russia. But they still want to sort of move themselves off that. So the question is, if you're sort of stuck in this part where you can't get an energy price solution without getting a European solution first, how are you going to get there? Well, the US have promised more gas. Having said that, gas prices in the US, which were sort of very similar to Australia in terms of being very, very low, and they basically had a reservation policy there where they couldn't export it. they're sort of, in terms of Australian dollar terms, I guess you must be talking around about $4 or $5 as well, would be a typical price per gigajoule. It's now almost $10, but that's still 70% lower than Europe and a similar amount lower than Australia. There is a lot more LNG to come out of the US. There's a lot of plants in production. So and I guess given the amount of gas they have that sort of gets produced. So whereas in Australia, the gas that comes out is coal seam gas. So you basically you're only digging up the gas. You're doing the fracking, but all you're getting is the gas out of it. In the US, a lot of the time, what's happening is the gas is a byproduct of actually pulling out the oil. So they have a lot of shale oil there, and that's where most of the growth is coming from. And so they do actually have a lot more gas that can come out, and at these higher prices, all of a sudden, some of these wells that might not have had much oil but had lots of gas that weren't being exploited because the profitability wasn't there. Now you've sort of tripled the level of the gas price. You can expect that over the next few years there's more gas and there's more oil to come from the US. So I've got a chart.
The plans for more exports in the US are spectacular, but and there is a decent amount coming out later this year. It might be another 10 to 20 million tons. Probably not enough to be market moving.
No.
And then the rest of it is further out. So there's no real solution coming out of the US in terms of addressing the short-term problem for probably 3 or 4 years, at which point there's a staggering amount of gas as well coming out from Qatar as well.
And I guess the other thing to remember is there's probably a price in Europe that they're sort of willing. There's a level of pain they're willing to accept, and so I guess the question is if they're paying current prices, and the US produces some more, does that just mean then they just cut off a bit more Russian gas, and sort of just play it as a in the short term, it's basically going, well, whatever the price limit they're sort of willing to accept. If the prices start to go below that, well, then they just get rid of more Russian gas until prices get back up to that level.
Yes, and Europe, we haven't even talked about coal yet, which is kind of interchangeable with gas, and Europe hasn't even banned Russian coal until August. So its gas needs, are going to rise when that comes in as well. So yes. Europe's as the marginal price setter is not going away in a hurry. I mean, the Russian sanctions are more or less permanent. Even if the war ends.
Yeah. So the other thing is, I've got a chart on the right here, which is just it's not a forecast. It's just a quick what if, saying, okay, well, if Europe actually did want to get off fossil fuels, how much fossil fuels do they have? That's the yellow line on the right. How much fossil fuel capacity do they have in terms of electricity production? And then the blue line is how much have they been putting on in terms of annual new solar. And the red line is basically saying, well, what would happen if they grew for the next 10 years? Until 2030, for the next sort of 7 years, they grew at 20%, the amount of solar that they were going to put on. And then after that, they grew at 10%. And I guess the main reason for showing this is just sort of putting some just rough figures out. Nobody really knows how fast they can move across to adding more renewables and more solar. But I guess the main issue is you can sort of see that yellow line there. It's relatively flat at the start. Like, it doesn't really make that much difference. But once you get out to 2030, that line gets very, very steep. It's a snowballing effect. So basically, if you as they add more and more capacity to make solar panels, you end up making 100 million gigawatts of solar panels in a year. If the next year you turn that then into 110 or 120, you're just snowballing that effect of the amount you're taking off every year is just growing and growing and growing. And so we're sort of looking upon this whole, what we think is that this has brought forward this shift to renewables probably 5 years forward at least in terms of it, because Europe is no longer turned around and making economics part of the priority. They're sort of looking at their path to renewables and saying, longer term economics is the priority, not the short term economics. And what that means is that they're considering a whole range of different interventions into this market. Subsidizing people who are making new factories to build solar panels, dropping taxes, mandating that every government building will have solar panels on them, looking at mandating whether every new building has to prove that it can't have solar panels, as opposed to so that every new building will have solar on it. And the idea is that this transition, it's going to be slow for the next few years and almost imperceptible. But if they're going about it in the way that we think they are, then that's going to turn exponential, that growth, and very, very quickly, sort of once you get out close to 2030, you're just going to see that the demand for fossil fuels drop off quite dramatically. I didn't actually throw up our graph here, but putting in perspective some of those numbers. So we spoke about the wholesale costs being about $50 a megawatt for power in Australia before, and going up to now it's about $300. Solar costs are sort of around about the $20, a bit below the $20 level. So solar was already very, very attractive. Now you have to add a battery, and battery costs does add to it, and it really depends upon how long you want the battery storage for. But if we're only talking about battery storage to get you through that main peak of the night, get the bulk of it done, then in $300 of wholesale cost, there is plenty of room to have batteries make up that extra. And there's just the economics. I guess what I'm saying is don't what we think is there's been two dramatic changes. One is that the economics of the situation is that all of a sudden solar plus battery is dramatically better than any fossil fuels out there, given the current fossil fuel prices. That's the first part. And the second part is that geopolitical impetus now to get off fossil fuels as fast as possible in Europe is going to create a much faster path to this than what we would have seen otherwise.
So what you're really describing is an enormous private carbon tax.
Absolutely. Putin's carbon tax that he's put on the rest of the world.
Yeah. And the gas cartel is applied to Australia.
The only other one then is China. Just to note, China's a little bit insulated in terms of costs. So they do have their own massive coal reserves, and they've been expanding that quite rapidly recently, and incentivizing local production. They have also increased the amount of Mongolian imports and the amount of Russian coal that's going to end up in China, and Russian gas that's going to end up in China. We would expect to be like that. China's benefiting in sense that they are happy to take Russian coal and Russian gas, and so as Europe transitions off it, China's going to pick up this Russian gas quite cheaply, because basically they don't have other places, and Russian and coal, they'll pick it up because Russia just literally won't have other places to sell it to. And so I guess there's over the last 10 years, China's been the marginal consumer of energy, and so really have been setting what the energy costs have been. We do think that's going to change over the next 10 years. Is that they're going to benefit from this in terms of lower commodity prices, while Europe turns into the marginal price setup. Right? Is that, Dave? Anything else globally have I missed?
No, that's right, and that's a big problem for Australia with their current policy settings. So it's
a big problem, I guess. In mine, like I suppose I'm being optimistic in it, but it seems like it's a from a save the planet point of view, it is actually a vast change, and it's going to,
yes,
in my view, this is going to make the whole global warming dramatically better.
Yes.
The problem is we've got 5 years of pain right now of ultra high prices unless Australia actually does something from a policy perspective.
Quite right. And so let's discuss what that would look like. So the Morrison government pretty much was married to the gas cartel in Australia. Actually, let me take one step back. The last major crisis we had in the gas market was 2017, when it became clear that Australian end users were paying more for local gas than our Japanese export customers were paying. That triggered a big media kerfuffle, and Malcolm Turnbull was forced to act and to actually create some domestic reservation for East Coast gas, which, as we know, is already in place in WA, where the price is currently $5.50 as opposed to $40 in the east. So Malcolm Turnbull created the Australian Domestic Gas Security Mechanism. He did it by pulling in the gas CEOs and basically just saying to them, this is violating the social contract. The gas price is at $20. It's going to filter it through into electricity prices. This is inequitable, unethical, and unacceptable. And he forged a heads of agreement with those executives in which they more or less committed to offering the gas volumes to needy Australian end users before they export it. Now, subsequent to that, over the next sort of 3 to 6 months, can't remember exactly, the price halved, went down to $10 a gigajoule from what was 20. So it worked. So
still double WA, but
yes, but at least it got, and then it did keep falling from there, basically as that global gas glut persisted, and we had COVID and what have you, and ended up going quite low. But as a policy process, it was reasonably effective. So then we move into the Morrison years, where essentially the Morrison government was bought and paid for by the gas cartel. They donated something like $700K, I think it was Santos, and Morrison policy was dreadful. It just supported, its only notion was to increase supply to fix the gas shortage, which may sort of make sense to you in a 1 + 1 = 2 sense, but there were details in it that meant it was never going to work very well. Most especially, it began reserving specific projects for domestic use when this cartel has a portfolio of gas extraction areas. That means it can just jostle stuff around and keep exporting way more than it should. So the whole gas-led recovery business, which was supposed to fix it by getting more production, was never going to work because you have no blanket reservation. And as long as you have no blanket reservation, then it can easily be manipulated.
Well, it depends on how you define work, David. Is it going to increase the profits of the companies involved?
Well, yes.
Then absolutely, it's going to work
for in a rational sense. So that brings us to today and our next iteration of the crisis and what should be done. Now, it's very obvious that the easiest way to fix this politically is to go back to that AD-GSM that was created by the coalition, reboot it, and either it has a trigger mechanism in it, and you can just pull that trigger and call in the executives, or you just threaten to pull it and call them in, and you rewrite it. Like, you just say, this is not acceptable. This is just kindergarten politics, right? You just basically say you violated the social contract. If you don't lower the local price one way or another, then we're going to appropriate this or that, or we're going to put 100% export levy on you. The Australian government holds the whip hand here in any real terms. It's simply a matter of political will. Now, we've had Jim Chalmers, the Treasurer, and Chris Bowen, the new Energy Minister, come out today and say they're not going to do it. Well, this is just cowardice. That's all I can put it down to. It's either cowardice or corruption. They're afraid of a mining lobby attack on the government, I guess a la the RSPT and Rudd, or they're afraid of the fact that if we reserve more of this gas, it will very likely mean some LNG cargoes that would go to China will declare force majeure and won't go. So they're afraid of the Chinese, who for some reason they want to be friends with, or they're afraid of the cartel, or they've got these donations they want to look after. But there's no good kind of assessment of their policy thinking on this right now, because the easiest win here for them is to just use the ADGSM, and it was created by the coalition, so it's bipartisan. They can't even be attacked by the coalition. They did it before.
They will be attacked by the coalition.
Well, they may well be, but it's a pretty easy one to bat away.
Yeah.
So, now
but it is worth noting as well that this is Boris Johnson, who's from the right politics and very right hand side of politics, has attacked one of these taxes on in Europe.
I've been pushing this because this is the easy political way to do it. Right? If you were going to do it properly, you would actually apply a 100% war profiteering levy that basically took all of the export sales above pre-Ukraine commodity prices. That's actually the appropriate thing to do. Now, I've just decided, in my wisdom, take it or leave it, that Labor was always going to be way too cowardly to go anywhere near something like that, because it can be represented as a super profits tax. But if you did do it, you would suddenly have like scores of billions of dollars pouring into the Australian government coffers, which could be put in a sovereign wealth fund. And that windfall from a war would actually go to the owners of the assets, the Australian people. So that's what should happen. That's never going to happen. The watered down version isn't happening either. And if they don't happen, there's no other obvious other solution. So LNG imports haven't even started. They can't solve this problem anyway, because
LNG imports. They're just
benchmarked to global prices anyway.
Yeah,
so they
crazy.
give you.
That is crazy.
Well, it's insane.
We're going to pump gas out. We're going to put it on a ship, and then we're going to sail a ship up to China. Meantime, we're going to sail another ship from Qatar over to East Coast.
Exactly. So domestic production will help, but won't work, because even more of that will be exported because of the portfolio nature of the reserves. LNG imports can't fix this problem, although they will at least benchmark the cartel to global prices, so they work in that sense, but it's still preposterous. For instance, right now, with Australia having no gas and a failed gas market, China is reselling LNG cargoes into the global market. Over 70% of this East Coast gas goes to China, and I don't know if they're selling Australian cargoes. That's not really relevant, but they're reselling LNG cargoes into the global market because they have a glut. So that's how preposterous it is. Like, people who don't want to do a domestic reservation regime are almost, and would like to do LNG imports, are essentially asking you to buy back Australian dollar gas that cost $1 to come out of the ground, got exported, and then asking you to buy it back for $35 so that it can be used here for $40. I mean, if economics is the business of efficiency, well, you can see how that might be a little bit of a problem. So where does that leave us? I mean, I think that basically Labor is making a catastrophic blunder here for the following reason: the gas and energy prices, utility bills, let's call it, are only about 3% of the Australian CPI. However, if they double, if they double, they're adding 3% to the CPI. That's for starters. So that will happen if they allow this to continue over the next year or two. There's a bit of a lag because of contracts and such. So it will be dripped in over time, but it'll become a perennial inflationary problem in the economy. Now, that's if we're only on current prices. If they get worse, that could easily go up. And of course, then there's a secondary spillover from that. And that is that all of these energy prices are the most fundamental input cost into every possible economic activity in Australia. So that all of those prices will be, sought to be passed on. And so you'll get an amplification in the CPI that suddenly takes you up to 6, even more over a couple of years of extra inflation for the RBA to deal with. It will become because it will disseminate throughout the entire economy, there's no way the RBA will be able to look through it. If it was a one-off energy shock that they thought was short-term, they could say, okay, we'll ignore that and we'll wait for it to come back down. But if it lasts for the period of time that it appears it will, owing to the Ukraine circumstances, it will just disseminate throughout every cost in the economy, and the RBA will be cornered into raising interest rates much further than it would otherwise. And so you'll be in a circumstance, in effect, where monetary policy is forced to make room for a war profiteering energy gouge that adds nothing to the economy. Nothing. It pays no tax. It won't trigger investment. It will take away. And yet the monetary policy will be forced into a circumstance where it has to suppress wider activity to give it space. Now that is just madness. That is like a sovereign failure. That people will argue, often trickle-down economists and the like will argue that to put in gas reservation is a sovereign risk. Okay, it's probably true a little bit, but in the circumstances that I've just described, that is risk to the sovereign. That has got nothing to do with sovereign risk. The risk is all for the sovereign itself, because you were talking about giving yourself an inflation problem that triggers a monetary policy circumstance that is going to smash Australians' wealth while it denudes them of income via bills. And in a living standards sense, it's insane. It is in fact a fundamental threat to the banking system for the same reason. And so when I look at Labor flopping around, worrying about getting mining backlash on this, I just think they're fighting the last war, in the sense that they're concerned they don't want to trigger another backlash from mining a la Rudd and the RSPT. But what they're doing instead is they're going to create a wealth and income drain on every Australian that will smash them to smithereens over the next 3 years.
And worse than that, David, is not every Australian, because the richer Australians who tend to own their own houses and be able to afford to stick on solar and batteries and stuff like that will be able to avoid a lot of it by putting on their own solar and adding batteries.
Yeah.
Whereas the poorest Australians are going to suffer.
Well, and of course, utility bills are a much higher component of their income as well.
Yes.
So it's spectacularly inequitable. It has nothing to do with any kind of Labor principle that I can think of. And so it is, it's a catastrophic miscalculation if they do not take this head on. But that's where we are today. So in terms of, I guess, possible investment implications, then you are talking about a more embedded inflation environment for Australia. Thankfully, the markets have been so crazy in selling bonds, and the great bond capitulation, that those RBA rate hikes are probably already priced. But of course, everybody's assumed that they were mispriced, and they may not be mispriced anymore if this happens. And so instead of just things like CBA calling the terminal interest rate at like 1.25, because as we've discussed many times, we've got the fixed mortgage rate at reset, etc. The RBA may just simply be forced to keep hiking to 2.5% and 3%. So you could end up in a circumstance where you have an extraordinary stagflationary shock in Australia, where energy prices refuse to fall. As housing markets crash, the economy comes apart, and unemployment rises, and the Australian dollar doesn't fall even, because yields are high, trying to chase these ridiculous energy prices. So it's an energy market failure that threatens an Australian market failure. That's how big this is. And I'm at a loss, to be honest, about why the Labor government is not interested in addressing it. Perhaps in time, but I think, honestly, if they leave this for 3 months, 6 months, by the end of the year, Australia will be in all sorts of trouble with the RBA on the march. And I guess the one hope is that we're still very bearish, really, on the global cycle, because I think, as we've seen over the last 2 weeks, when we've seen this bear market rally, what that really means for global inflation is that oil and energy, the moment the Fed takes its foot off the brake, they're going to fly. Oil just tacked on 25% the moment they'd sensed that the Fed may waver. And so I don't think the Fed can afford to, and we're going to see the Fed tighten into a slowing US economy and global, base case is still global recession. And so the one hope for Australia is that the global recession arrives in a way that crashes global energy prices, that includes gas. Now, so that's the one hope at the moment, that we might actually be able to clean this up. Now, there's one more factor to this that we haven't even mentioned and gotten to, and that is gas is only half the problem. Gas is the easy one. Gas has an existing reservation regime that Labor is refusing to use. Half the problem is coal, where we're seeing the same price rises, and New South Wales and Queensland electricity grids are much more exposed to coal than they are gas. And so the same questions have to be addressed for coal as well. So not only is the federal government failing to address gas, it has a much more difficult question to address in coal that is completely off the agenda. And so even if we get to a point where we address gas, we're still going to have this inflationary problem coming out of coal, especially in New South Wales and Queensland. So, yeah.
Come through from Peter. So he's curious to know, with the Senate makeup, what are your thoughts regarding renewable fast-tracking policies coming in maybe over potentially the next 6 months, especially sort of in light of this energy crisis backdrop?
Well, I think that'll absolutely happen, but it's not a short-term solution. You know, the other thing is, the moment you get more renewables in, the gas cartel can just keep tightening the screws all the way down. You have to get the storage in, renewable storage, you know, so battery, hydro, pumped hydro, etc. And they're, you know, longer term, bigger projects. By and large, battery costs are coming down. I mean, certainly with prices where they are, batteries will roll out like crazy.
Yeah, that's right. I think battery costs are probably flattened for the moment, but just given the massive global demand, it might even go up a little bit. But that doesn't matter, because
no, it doesn't matter with these prices.
Now the current costs.
So we'll certainly see a renewables boom, but again, you know, like that you roll back to economic capacity constraints in the RBA. I mean, you're dealing with some very, very strong inflationary and deflationary forces here, and you can have that renewables boom. It's going to happen anyway, but you don't have to have this extraordinary gouge going on while you do it.
Well, and that's the more important point, Dave, is that Australia is the world's biggest exporter of coal in terms of dollars. And we're talking about this tiny bit of coal we need to reserve locally for us. The fact that our tiny little bit gets slightly more tiny because or even the fact is we're still paying global prices for it.
To fix this crisis now, it'd probably be 5% of both gas and coal exports. Longer term, in gas, it might be more like 10 or 15. But right now, 5% of gas would do it. And so, you know, Australia's probably a big enough exporter that might even tick up the global price, and so it would cost the cartels nothing. to do this? Nothing.
Well, and we've got, the thing is, we have an active model. It's West Australia. It's not even a different country. It's just one of our states, which has the model for it. Yeah,
it does. Yes. And so, I mean, from the perspective of WA, they must be just watching on and thinking, those Eastern idiots, what the hell, you know? So, yeah, it's crazy times. It's insane policy. It's a new and scared government. And my recommendation to anyone that's a big user of energy is try to get off the grid as quickly as you can, and apply massive pressure to your MP, because there are solutions here. It's just political cowardice that's preventing them.
Great, thanks for that. And we've got another question come through from Sasha. So she's saying, with the unprecedented confiscation of Russian central bank reserves and exclusion from the SWIFT system by the US and Europe, are we looking at a permanent recoupling of the energy sector as countries take sides?
Well, we're certainly looking at 100%. We're looking at a redistribution of energy globally. Yes, there are enough resources to handle it, and as we've discussed, the sort of nature of the immense carbon tax, and this means that those resources will grow in relative terms because renewables will gobble up the grids and cars. But yes, there's a massive redistribution of energy going on worldwide, and it is going to be, it appears, more captured autocratic flows versus more captured democratic flows. So yes.
Well, and I think part of that's Russia has got now a limited number of people who will buy its oil and gas, and
yes.
But having said that, India will buy it and China will buy it, so that's half the world's population, just there.
Yeah, that's fair.
So it's not really but it just means it needs to reorient to get there, and it means more transport and
Well, it adds fantastic inefficiencies to the system. Like if Australia has to become a coal provider to Europe instead of China, it's 3 times the length, which is 1/3 the volumes that you can send at any given moment. And then Russian oil going to India instead of Europe has to be transferred through various tankers, etc., etc., etc. And so it does embed inefficiencies and high costs into all of these energies. Yeah.
Awesome. Thanks for those answers, guys. We've got lots of comments coming through in the YouTube chat. I just want to say this is the last call for any final viewer questions before we get into the investment implications. Just drop them in the chat below and we can answer them after this segment. But before we get into the viewer question, I just want to take a moment to showcase our new direct indexing products, as they're the first of their kind in Australia. So direct indexing is similar to an ETF in that it's a low-fee buy and hold passive strategy that tracks an index. But the main difference is you own all the stocks directly, and that allows you to customize your holdings in that index, so you can tailor it to fit your personal ethical values and beliefs. Whereas a traditional ETF, it's a one-size-fits-all that you can't change. So since you own all the stocks directly, you can actually customize the index by utilizing any of our ethical, sector, or asset class screens. And we have around 50 different screens to choose from. So just a quick example, how you can actually use this in practice. You could exclude Australian banks, for example. That's one of our screens. If you're negative on the Australian housing industry, or you can exclude any company that's involved in fossil fuels. So you really have the ability to customize your portfolio however you see fit. And like I said, we've got around 50 different screens there to take advantage of. So if you want some more information, please go to our website at nucleuswealth.com/direct indexing and have a look around. There's lots of information in there to have a look at. So now we've got our viewer question of the week. This is for viewers to have some discussion in the comments section over the coming days. And the question for this week, should Australia intervene in the energy markets? So feel free to post your thoughts and engage with us.
Yes.
Simple answer. That's a bit of a no-brainer.
Well, I mean, the answer's in the question because there are no energy markets.
There we go.
Well, they collapsed. They've failed. So
they failed, yeah. I guess they have failed. So feel free to engage with us and some of the other viewers over the coming days. And guys, Damien, I'll pass it back to you for the investment implications.
Actually, Dave, you can run through these ones this week.
Well, I more or less already did. I mean, just higher inflation in Australia, more rampant RBA. This is assuming Labor does nothing. Much steeper downside for house prices. And ironically, because, I won't go into that, but you're going to see more profits flow to this cartel and out of every other sector. So, you may or may not want to buy energy, but it's definitely going to be a real income shock for Australian households. So I would be wary of consumption, and the wealth impacts are going to redouble that. So I'd say the main investment implication is the concern that comes in around the stronger inflationary pulse and the results for the RBA.
Awesome. Thanks for that, Dave. So that almost wraps us up. So Damien, just want to thank you for joining us and putting the show on as always.
Thanks, Sam.
And Dave, appreciate your insights and sharing your opinions and views again.
Thank you very much, Sam.
So we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop them in the comments below or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com and you can book a call with me or one of the team. Don't forget to like the video now. And finally, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you could please share it with them. Also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content. And to stay up to date with news from us, you can also follow us on all major social media. So for myself, Damien, Dave, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.